The stock market is on edge again. Regional bank troubles are shaking investor confidence and dragging futures lower. But what's really at stake here? And could this be the spark for bigger market shifts? Let's dive in and unpack the latest developments in a way that's easy to follow. Even if you're new to all this finance jargon, imagine trading floors buzzing with activity, and yet the mood is decidedly cautious. On Thursday evening, U.S. stock futures dipped slightly, mirroring the sell-off from the previous day's session, driven by worries over regional banks' lending habits. For those just getting into investing, futures are essentially contracts that bet on where stock prices will go before the official market opens. They're a sneak peek into tomorrow's potential moves. Specifically, futures linked to the Dow Jones Industrial Average, that's a key index tracking 30 big American companies, slid by 102 points, or about 0.2%. Meanwhile, S&P 500 futures and NASDAQ 100 futures both dropped more than 0.3%. These percentages might sound small, but in the fast-paced world of stocks, they can signal broader unease. After the regular market close, some notable stocks caught the eye in after-hours trading. Take Interactive Brokers Group, for example. It tumbled more than 2%, even though it delivered impressive quarterly earnings, with revenue hitting $1.61 billion and beating expectations. And Oracle, the cloud computing powerhouse, slipped over 2% after sharing its long-term financial outlook, which included a massive cloud deal with Meta Platforms. Then there were the drug makers Eli Lilly and Novo Nordisk, both sliding lower following comments from President Donald Trump during a briefing on fertility treatments. He hinted that the administration was pushing for sharply reduced prices on their top obesity drugs, a move that could reshape pharmaceutical pricing but also stir up debates on government intervention in business. But here's where it gets controversial. Is Trump's approach to drug prices a bold step toward affordability, or an overreach that could stifle innovation in life-saving treatments? It's the kind of policy shift that divides opinions. Some see it as helping everyday Americans, while others worry it might discourage the big investments needed for medical breakthroughs. Looking back to Wednesday, the major U.S. stock indexes all ended in the red, with a sharp late-session drop in bank shares leading the charge. The Dow shed 301.07 points, or 0.7%, while the S&P 500 and NASDAQ Composite fell 0.6% and 0.5%, respectively. This plunge was triggered by disclosures from banks like Zions and Western Alliance about problematic loans, raising alarms about overly lenient lending practices and the possibility of similar issues cropping up elsewhere. For beginners, think of bank loans as the backbone of the economy. When banks make risky loans, it can create ripples that affect everything from home mortgages to business expansions. The SPDR SP Regional Banking ETF, which tracks smaller banks and has been declining for 4 weeks straight, plunged more than 6% that day. Adding to the banking jitters were the recent bankruptcies of 2 companies tied to the auto industry, amplifying concerns about financial stability. Market volatility spiked, with the SIBO Volatility Index, often called Wall Street's fear gauge, climbing higher. Treasury bond yields and the U.S. dollar weakened, while gold prices hit new highs, showing investors flocking to safe haven assets like precious metals during uncertain times. Gold, for instance, is often seen as a hedge against economic turmoil, because its value tends to hold steady when stocks waver. Liz Ann Saunders, chief investment strategist at Charles Schwab, weighed in on CNBC's Closing Bell that evening. She pointed out that these banking worries are colliding with a speculative froth in the markets. Think of it as bubbles forming around trendy, high-risk investments like quantum computing companies, drone technology, and unprofitable tech stocks chasing the next big thing. When speculative enthusiasm meets potential big-picture problems, volatility can spike, she explained, noting that this froth isn't concentrated in the giant tech firms anymore, but in smaller market segments, such as the Russell 2000 Index, which marked a new high on Wednesday despite the overall gloom. And this is the part most people miss. While the Russell 2000 is soaring, signaling optimism in smaller companies, The broader market turbulence hints at deeper cracks. Is this speculative frenzy sustainable, or are we seeing the early signs of a correction that could burst these bubbles? Beyond banking, other pressures persist. Global trade tensions and tariff policies, sky-high market valuations fueled by the artificial intelligence boom, and the ongoing U.S. government shutdown. This shutdown, now in its third week, has halted key economic data releases from federal agencies, data that investors rely on to make informed decisions, like employment numbers or inflation reports. Yet not all is doom and gloom. For the week, the S&P 500 is up nearly 1.2%, buoyed by a robust start to third-quarter earnings season, where companies report their financial results. The 30-stock Dow Jones Industrial Average has gained about 1%, and the Nasdaq Composite, home to many tech giants, has risen 1.6%. These gains show that strong corporate performance can still lift spirits, even amid challenges. 1 hour ago, Novo Nordisk, Interactive Brokers, CSX among stocks moving in after-hours trading. Let's spotlight some companies grabbing attention after Thursday's market bell. CSX Corporation, the railroad company's shares surged 2% thanks to solid quarterly results. It reported adjusted earnings of 44 cents per share on $3.59 billion in revenue, edging out analysts' expectations of 42 cents per share and $3.58 billion. Factors like falling coal prices and reduced merchandise volume slightly impacted revenue, but the overall beat kept investors happy. Interactive Brokers Group, despite posting better-than-expected results, with adjusted earnings of 57 cents per share, topping forecasts of 54 cents, and revenue of $1.61 billion, surpassing the predicted $1.52 billion. The stock dropped nearly 3%. The firm highlighted a 21% increase in net interest income to $967 million, driven by stronger securities lending and higher customer loans. Oracle, shares of this cloud infrastructure leader, fell 2.4% in after-hours action following its long-term outlook update. Oracle projected a 31% compound annual growth rate for revenue over the next 5 years. During its AI World Conference in Las Vegas, the company announced a cloud computing partnership with Meta Platforms and emphasized growth in its core database and data platform divisions. Note, Oracle had already climbed 3% during the regular session. For the complete rundown of after-hours movers, check this link. Pia Singh, 1 hour ago. U.S. stock futures open little changed. What do you think? Is government interference in drug prices a necessary evil for public health, or does it risk undermining the pharmaceutical industry's drive for innovation? And with speculative froth building in smaller stocks, are we heading for a volatility explosion, or is this just a temporary dip? Share your views in the comments below. We'd love to hear your take on these market dynamics.